Are you looking for an easy way to invest in the stock market without having the hassle of picking and choosing single stocks? Well, lucky for you, there's an easy way to go about it through all-in-one index fund. An all-in-one ETF is a low-cost exchange-traded fund that allows you to have diversified investment in the stock market globally by just only holding that one single ETF in your portfolio. So you won't need to buy any more stocks or ETFs. Instead, you can hold on to that one single ETF and that will be sufficient for your portfolio. Now, there are different firms that offer such type of ETFs, but our focus for this video is on Vanguard. Vanguard has been one of the most reputable firms offering low-cost index funds, and that's why we are going to be sharing with you 5 choices that you would have as an investor. The reason I'm sharing with you 5 different ETFs is that the risk tolerance is different for investors. One might have a higher risk tolerance, wanting 100% exposure to stocks. And on the other side, there might be investors that would like a lot less exposure to stocks and higher level of exposure to bonds. Hence, we'll be sharing with you those 5 ETFs, giving you the choice to select one that best suits your needs. Let's get into it. All right, the first pick for us is Vanguard All Equity ETF Portfolio with ticker symbol VEQT. As the name suggests, VEQT has 100% exposure to stocks. This is best suited for investors that want the highest level of risk and exposure to the stock market. Again, VEQT, similar to the other 4 ETFs that we'll be reviewing, gives you a diversified approach to the global stock market, including US, Canada, international markets, and emerging markets. With VEQT, you're seeing assets under management AUM of $2.94 billion, and it has a management expense ratio MER of 0.24%. VEQT does pay a dividend distribution, but it's only paid once a year, and currently it has a 12 months yield of 1.86%. The dividend yield for VEQT is typically paid in the month of January of each year. Looking at the past return for VEQT here on this table, the 1-year return is up by 14.3%, 3-year is showing a return of annualized 9%, and the return since inception is at 9.7%. It's worthwhile mentioning that VEQT was incepted back in January of 2019. For VEQT, you're getting exposure to over 13,000 different stocks and no bonds. Majority of your exposure is to US market at around 44%. Following that, you have around 30% exposure to Canada, 20% exposure to international markets, excluding North America, and around 7% exposure to emerging markets. In terms of the market capitalization, your biggest exposure is to large cap businesses, though you have some exposure to medium and small size businesses as well. Looking at the sector breakdown, the top of the list, we have financials at around 19% of your holdings. Then we have around 19% as well for technology. And following that, we have industrials and consumer discretionary. The rest of the market sector exposure is showcased for you here on the screen as well to take note of. As for the biggest holdings for VEQT, you're looking at companies such as Apple. You have around 3% exposure to Apple. Following that, you have Microsoft, Royal Bank of Canada, Toronto Dominion Bank, Amazon, Shopify, Nvidia, Canadian Pacific, Enbridge, and Canadian National Railway. Moving on, if you look at our second pick here, this is more suited for investors that want a little bit less risk and some exposure to bond market for kind of a little bit more stability, is VGRO, or Vanguard Growth ETF Portfolio. Here, 80% of your exposure is to stocks, 20% to bond market, fixed income. It has a similar management expense ratio of 0.24%. It does pay its dividend distributions on a quarterly basis though. With VGRO, assets under management is at $4.23 billion. The inception date for VGRO goes back to January of 2018. Looking at the past return for VGRO, 1-year return is up by 11.5%, 3 years annual return is at 6.3%, 5 years annualized return of 6.2%, and the annualized return since inception is at 5.97%, close to 6% annually. It's worthwhile mentioning that you still have quite a considerable exposure to US market, both through total market index as well as the exposure to the US bond market. You have considerable exposure to Canadian markets through 24% exposure on Canada All Cap Index ETF and some Canadian aggregate bond at around 11%. Following that, you have kind of exposure to the international market, excluding North America, through the stocks, as well as some bond market exposure. And lastly, you have some exposure to the emerging markets as showcased here for you on the screen. I want to also point out that you still are getting that 13,000 plus different global stocks in your portfolio. However, on top of that, you're also getting the 18,740 plus bonds as part of your holdings too, which you can easily take a look at and check it out. For example, for the equity market, Apple, Microsoft, Royal Bank of Canada, TD, and others are your top holdings. But there's also a tab for fixed income, which as you click on it, it shows you what are some of your top bond exposures. As for the market exposure, the breakdown of market exposure, similar to VEQT, you have the highest exposure to financials, technology. You do have high exposure to industrials and consumer discretionary, and the rest of them are showcased here on the screen. Things like healthcare, energy, basic materials, consumer staples, utilities, telecommunications, real estate, and other. Our third pick is VBAL, Vanguard Balanced ETF Portfolio. Here you get about 60% exposure to stocks, 40% exposure to the bond fixed income. It has the same management expense ratio of 0.24, and it does pay its dividend distributions on a quarterly basis. VBAL has approximately $2.5 billion assets under management. And if you look at its past return, since its inception date, which was back in January of 2018, the inception return since inception is at around 4.5% annually. 5 years return is at 4.69 or around 4.7% annually. 3-year annual return of 3.6%. 1-year return of 8.4% is shown here on screen. You have a considerable number of stocks, around 13,640 that we talked about in the past, and 18,700 plus of bonds. It's just that the weightage is different. So you're getting much more weightage towards bonds compared to, for example, VGRO. 40% is at bonds and 60% at stocks. And the percentage by different geographical markets is shown here for you to take a note at. If you look at the breakdown by the market cap, not surprisingly, similar to the rest of the ETFs that we reviewed, majority of your exposure is to large cap. Following that, we have medium and small cap too. And if you look at the breakdown by market sectors, majority of exposure is to financials. Following that, we have technology, industrial, consumer discretionary as your top 4 market sector breakdowns. Top companies include Apple, Microsoft, Royal Bank of Canada, Toronto Dominion Bank, and Amazon. If you scroll to the fixed income tab, you'll be able to as well see your exposure by different bonds. Moving on, we have Vanguard Conservative ETF Portfolio. As the name suggests, here you have higher exposure to the bond market fixed income and less exposure to stocks. VCNS was incepted back in January of 2018, and it has about 60% exposure to bonds and 40% exposure to the stock market. It does pay a dividend distributions on a quarterly basis and has a management expense ratio of 0.24%. VCNS has approximately $481 million in assets under management. If you look at the past return for VCNS, the 1-year return is up by 5.6%. 3 years annual return is not the greatest, only at just shy of 1% annually. 5-year annual return is at 3.15%. And the annualized return since inception is at 3%. You do notice that the Canadian Aggregate Bond Index is one of the largest holdings at around 35%. And then we have total market index for US at around 70%. And the rest of the breakdowns are showcased here for you. If you look at the market sector breakdown, similar to the rest of the ETFs that we reviewed, majority of exposure is to financials, technology, and then we have industrials and consumer discretionary, followed by energy. Looking at the top names for the holdings, Apple, Euro USD, Microsoft Corp, Royal Bank, Canadian Government Bond, Toronto Dominion Bank, Canadian Government Bonds, Amazon, and Canadian Government Bond, different types of bonds. Lastly, what if you have the lowest level of risk tolerance and we want to have the highest amount of exposure to the bond market? Well, good for you, because we have one option for, here to offer to you. For this fund, that is Vanguard Conservative Income ETF Portfolio with ticker symbol VCIP. It was incepted back in January 2019. Here you get about 80% exposure to the bond market and 20% to stocks. So here you have the least amount of exposure to stocks and highest amount of exposure to the bond market. It does pay a dividend distribution on a quarterly basis. It has assets under management of approximately $210 million. It's one of the smallest one in terms of assets under management compared to the other 4 options that we reviewed. With VCIP, if you look at the past return for it, the 1-year return is only up by 2.8%. 3-year annualized return is negative 1.8%. And the annualized return since the inception is only at 1.7% annually, which is quite low, given that you have a lot higher exposure to the bond market. The approach that I think for many investors that are perhaps looking at maybe retiring in several years down the road is potentially having higher exposure to stock market. That's where you get majority of your nice gains. It's going to have higher volatility, but over a long enough span of time, typically the stock market returns better than the fixed income or bond market. Something for you to consider if you don't have to tap into your savings right away, or you have a longer term horizon before you get to that retirement age. You have same number of stocks and bonds here. It's just that the exposures are different. And in terms of the holdings, you do notice that around 46% of exposure is to Canadian aggregate bond market. You have around 17% to US, excluding US, actually, international aggregate bond market. US aggregate bond market is at around 16%. The US total market index stocks is at around 9%. Canadian all cap index ETF is at 6%. And the rest of it that you see here on the screen. The emerging market gets one of the least level of exposure at only around 1.5%. You do notice in terms of the market sector breakdown, still financials, technology, industrials, and consumer discretionary are among your top 4 holding. Well, there you have it, folks. A quick look into 5 high quality all-in-one index funds that you can pick from depending on your risk tolerance, if you would like to pick one of such options from Vanguard. I don't encourage you to pick and choose multiple of these ones, because the most important thing is for you to decide on your risk tolerance. For instance, if your risk tolerance is the highest level of risk tolerance, you could simply go with VEQT. If you have less risk tolerance and want to have some exposure to bond market, you could go with VGRO, VBAL, and the other options that we talked about. Or if you want to have the highest level of exposure to bond market and least exposure to stock market, VCIP was the option that we talked about. All of them had the same amount of management expense ratio at 0.24%, which is quite decent for one single ETF that allows you to forget about having to pick and choose stocks, making things a lot easier. It's buy one, hold it for the longest term, and be happy with the return over a long enough span of time. I did mention at the onset of the video, there are alternative type of funds from different firms that give you similar type of exposure. For example, BlackRock offers things like 𝗋𝐋𝐈𝐿, 𝗋𝐋𝐈𝐿. That's in fact the holding that I have in my portfolio. It's very much similar to VEQT. The main difference I would say between VEQT and 𝗋𝐋𝐈𝐿 is that with 𝗋𝐋𝐈𝐿 offered by BlackRock, you have higher exposure to the US market, a little bit less exposure to Canadian market, and the management expense ratio, the fee, is slightly less at 0.20%, which is why I personally went with 𝗋𝐋𝐈𝐿. BlackRock offers similar type of packages, but that's the topic of another video for another time. If you're interested to learn more about investing in the stock market, whether you're a beginner investor or an advanced investor, be sure to follow us here on Momentum Finance. On Momentum Finance channel, we post every week videos about investing, including investing in the stock market and ways to reach financial freedom. I also share my own portfolio transparently, what ETFs I'm buying and at what pace, what is the entire portfolio that we have, and how much dividend income we have, and all of that. Plus, if you want to follow me along on a real-time basis and know exactly what I'm buying and at what price, be sure to follow me on Blossom, a social app. I will include the link for you to easily download the app and join us on Blossom. Thank you, and I hope to see you all next time.